Welcome, ladies and gentlemen. So welcome to the first presentation that we are doing under the new managing committee. And just in case if you don't remember or know the new managing committee people, I'll just briefly introduce you. This is Rauf Walijan. He's the new president chairman of the chapter. Then it's I'll go. This Farooq Anwar. He's the finance guy. Right. Then we have Mohammad Ali, he's the vice chairman. Then we have Ruj Fatma, he's the secretary, and myself. Okay, so the program, I'm sorry for the delay because we had connectivity issues. So this is the first time we're trying to webcast this event to people outside the GTA. So we're kind of getting teething problems, but I guess we're now ready, right? Okay, so the way this will do a program will go is we have two presenters, Mohammad Ali, senior chartered accountant, and Mohammad Aman, another senior chartered accountant. Both are experts in their fields. So they'll be making a presentation which will last about an hour. After that, there will be a Q&A session for about half an hour. And after that, there will be lunch and networking. So without further ado, I will request Nadeem to start off the proceeding.
Assalamu alaikum everyone and good morning. I hope everyone can hear me. Today's session is on personal taxation. I'm excited to see so many people attending this session. Recall I did a couple of years ago, I guess, similar session, and there were only a handful of people. So I guess this indicates that our population is growing in Canada, which is a good thing. And I guess you're excited to learn about taxation as well. Those of you who have been in Canada for some time and exposed to Canadian taxation will appreciate that taxation is a very complex act within any legislation. And to expect one person to be an expert, as Shah mentioned, is probably not possible. Even very senior tax professionals who are working in any specific area of taxation, generally even in their own area of taxation, they need to consult other professionals because if they haven't dealt with any specific situation, they have to go back and talk to them. So saying expert is probably not an appropriate term, but we will try to the extent we can. And in terms of practice, if you're working in any, those who've been here for some time, they know that in Canadian economy, specialization rules in every aspect, and of course, taxation is no different. So if someone is working in any specific area, for example, corporate taxation, it is likely that they won't have much knowledge in terms of issues that you encounter in personal taxation and vice versa as well. So we'll try to answer your question as much as I can. I don't personally work in personal taxation, but we'll try to do and we have Aman Saab who presenting with me. He is practicing in personal taxation and private corporation as well, so he'll be probably more useful to you than I am. And we do have Iqbal Merchant, my mentor. He was tax partner at KPMG for a long time. Now he's head of taxation in Canada for RBI, which is the parent company of Tim Hortons and Burger King. So he's a resource person. I know I'm putting him on his spot. I'm putting him on his spot, but he's a resource person. Of course, he deals with high-level, cross-border, and corporate tax planning matters, but I'm sure he'll be helpful as well. So I guess with all that caveats, probably you will, by now you'll know that you're not going to get a lot from me today, but we'll try. Listen. So can we move to the next slide? Oh, is it here?
Yeah, it's not my laptop. Proof.
Technology guys. Yes. Our objective today is just to give you a brief background of what Canadian personal taxation is all about. We'll touch upon some topics relating to Canadian personal taxation. So here's the agenda, just to walk you through what you should expect today. So we're going to talk about liability for income tax, who is liable for taxation in Canada. Residency, we'll talk about residency. That's a topic that there are a lot of misconceptions, as well as there have been a lot of cases because determining a residency is the most difficult thing in taxation, personal taxation, I would believe. For most people, it's straightforward, but in situations it gets complicated. And next, we'll talk about who is required to file tax return, and then even if you're required to file tax return, there may be a situation where you may not want to file tax return. What happens in those situations? We'll talk about some administrative matter, filing deadlines, and what are the methods of filing with some administrative information about filing, for example, amended tax return, notice of assessment, filing objection, and appeal. Then we'll get into a little bit more detail, and that's where Aman Saab is going to jump in and will explain the common inclusion in personal taxation, what common deductions you have in personal taxation, income tax rates, common tax credits, and some other information. Then, if time permitting, we'll get into the retirement benefits. I know a lot of us not close to retirement yet, but still, we want to plan for that. And then at the end, we'll talk about some tax planning ideas and some learning resources that you can refer to afterwards. After the presentation, we'll email you the slide deck as well for your future reference and some other handouts that we wanted to bring hard copy for, but we are going towards cleaning the planet, so we didn't want to bring hard copies. We'll email those handouts to you. So can we move on to the Sorry. So, liability for income tax. Who's liable for tax in Canada? Canadian residents are liable for income tax. Now you'll ask, who is Canadian resident? We'll talk about that in the next slide. Non-residents, they are only taxable on their income that is Canadian source. So if you're not a resident coming to Canada, have a job or business income, you're taxed only on that income because you're not a Canadian resident. For individual, taxation year is calendar year, that is the calendar year followed, and for 2017, December 2017, tax returns are due April 30th. We'll talk about that in slides. Next slide. Residency. So that is the core. I think if I would say you want to take home any couple of concepts from this presentation, unless you already know these things, then you may want to focus on other details. But if these topics you take home, you would have achieved your objective. Residency is a matter of fact. Depends on certain situations and depends on individual circumstances. More prominently, this residency is decided based on your residential connections, and the CRA generally views those residential connections as your primary residence. If your resident you own or rent a house in Canada, that's when you become Canadian resident. Or second primary factor is if you have your spouse living in Canada or dependent children living in Canada. Those are primary factors that CRA considered in determining your residency. There are other factors as well, social, even if your spouse or yourself not living in Canada, but you are citizen and you have strong social ties with Canada, even though you are living abroad. But there could be a situation where this factor is so strong that you will be held resident. And what the implication is, if you are resident in Canada, then you are subject to tax on your worldwide income. Not just Canadian income, but worldwide income. We'll talk about how you get into avoiding double taxation through Canadian system or international tax treaty. So that is why it's so important to find out whether you're Canadian resident or not. For me, for example, I've been here for so many years. I have my house. I have been working here. It's straightforward. I'm a Canadian resident, right? For someone who is just coming into Canada, for example, landing in Canada in 2017, partway through the year, after let's say June. Now, the question is whether you are a resident or not. Right? You came here on December 31 or December 30th, landed here permanently with your family. Are you a resident for 2017 or not? Or the other way around, you are in Canada, you're a resident in Canada, you left Canada during 2017. Question is, what part of the year you are resident in Canada, what part of the year you are not resident in Canada? If you are resident in Canada for the entire year, you are subject to tax on your worldwide income. So there are severe consequences, and this is a very subjective issue. There have been a lot of court cases on this, and the oldest case that being referred to still was from, I think, 1946. Even when before I was born, most of it before. And that was a landmark decision is still being followed, and that's basically very high level basis. Concentrate on where are your strongest ties. If your strongest ties with Canada, you are held resident in Canada. There are other factors that CRA consider which are not necessarily primary factors. For example, if you have a Canadian provincial driver license or health card, they could contribute bank accounts, they could contribute as factors as well, but those are secondary factors, not key factors. So now I want to jump into more detail, and as I said, this is a key concept, so I want to spend more time on this than other slides, because those other things, computation of taxation is pretty mechanical. You can look at it on your own and try, and you can figure it out. It's not very difficult. So as I said, take a situation when someone coming into Canada partway through the year, and before I go there, I think I should also mention deemed resident was the concept. If a non-resident coming into Canada is staying for more than 82 days, then they are considered a deemed resident. That's another classification, and you are taxed just as a Canadian resident. Where we get into those situations where where somebody comes traveling into Canada, and this is, I think, pretty much a universal concept. So even in Pakistan, probably a similar concept applies. So now getting into a situation where a person lands in Canada, let's say in September. By December, they haven't completed their 182 days, so they're not deemed resident, right? But they have landed here in Canada. They rented a house or own a house. His spouse is here, right? So they become Canadian resident right from the day of landing going forward. So in this first year, they're going to be non-resident for the period that they were not resident in Canada. I mean, they didn't arrive in Canada. And then for the period when they landed in Canada and started their social ties, which is renting a house or owning a house, that's where they become resident, and they are taxable on any income that is earned on a worldwide basis during that period. So September onward, they will be taxed on their worldwide income, right, in Canada. Any income earned before that point is not taxable. You need to report those things for social benefits because they want to determine how much your personal family income is, but that's separate. That has nothing to do with income tax law. So far, any question on this?
One thing. Sorry for interruption. This topic is very, very important for you as well, because whenever someone lands here, basic concept of income tax aid to determine either you are taxable or not. This is not a concept. Even you are a citizen of this country, you are still not liable to pay tax if you are non-resident. So basically, citizenship, residency is not a criteria. Okay. So citizenship and residence is not a criteria. Criteria is only the days that you are gonna spend here and core ties. Core ties are basically you are living here, your house is here, your family ties are here, and you have your bank account. These are core ties. If you don't have core ties and you are living abroad, you are not supposed to file these taxes. But if you live here 183 days in a year, you are supposed to be, you are deemed to be resident. Even you are a citizen, you are not away from this country, but you are supposed to be there. This was the one thing which normally people confuse. Either I'm a citizen, I have to file a tax return or not. Even you are a citizen, if you are not living here, then you are not supposed to file a tax return.
Thank you. Thank you, Hamza.
Sorry.
Yeah.
All the 4 nights have to be there, or anyone is?
Anyone.
Anyone.
If your spouse is here, doesn't matter where you're living, if you're a resident, otherwise, yes.
Those who are living here on super visa, they reside more than 180 days a year. So what about those? Like my parents are here on super visa, are they subject to?
They are deemed resident.
They are deemed resident and they are supposed to file a tax return. And another good thing is they may be dependent upon you. You can take credit of those parents as well.
So
I just want to add towards the clarification of that this decision is made by CRA. There is a form which has been sent to them. So if you are professional doing for your life, would make it.
yeah, this is, but it's here.
It has to be done by
Yeah, so I'll explain on that point. Is yeah, CRA.
There are audience on the webcast as well, so that's why
Sorry, my name is Alsa. What I'm trying to explain is that people who are professional in dealing with rights, they should not make this the residency decision themselves. Because there is a 6 on page 1, which has to be submitted to the CRA.
And then CRA makes the decision that if this person is resident or not resident. And like you said, person who is a citizen and an non-resident doesn't have to file taxes. You don't have to jump out of rules to get to that. So it's not a decision which has to be made. Right? And the next one that has to be made by very important.
Yeah, thank you.
Just repeat the questions. People didn't understand it.
Yeah, the question, it was not a question, it was a comment that top, right? Yeah, was trying to mention that there is a form and there's a CRA which lays down, which asks all the questions, and they make a determination whether you are resident in Canada or not. So if you are coming into Canada, you may want to file the form, or if you are leaving Canada on a permanent basis, you want to make a determination whether you are a resident or not. Yeah, the CRA, you can use that form and file with the CRA and they will give you an answer. But the point here is, it's not CRM going to determine your residency. They can determine your residency based on their own views. But based on legislation, you have to look at your own facts and consult a professional whether you're a resident or not, in your view. You may disagree with CRA, and that's why these court cases arise, right? So CRA's form is only their views. You may have different views, but whether your views are correct or not, you have to, of course, consult a professional unless you know the act yourself and you have gone through all the legislation.
Just one clarification in that. Just hang on a second. One clarification in that. If when you're going to file your T1, on the very first page, it is written there, you have to supplement your dates. You have to write there when you landed in Canada. So they are going to determine from that point that you are resident. Don't confuse with those long statements because that is a resident status. If they have some dispute, they are going to decide in that way. But for E1 general, when you are going to file that, on the very first page, it says when you landed. If you're going to say this thing, this is my month, and this is even they require the day of that because they have to calculate that period. So there you have to decide, and the same way they are going to decide your benefits as well. Prior to that, not entitled for any benefit.
Thank you, Ansam. I know this residency issue is really, really complicated, and we have tons of questions. Let me go over whatever I have to say, and then we can address those questions afterward. Otherwise, we will run out of time, and then we'll still be there, right? One more aspect of residency is there is a general concept that whenever I land in Canada, I become Canadian resident. As Ansam mentioned, file your tax return, you mentioned what is your date of landing, right? But not necessarily you become a tax resident as well, right? When you land into Canada, for example, I came here 1 year, I just came here because there was a deadline to land. I landed here, got my papers, went back for a few months, and then came back, right? So that the second time when I come back, that is the point when I'm establishing my social ties with Canada. The earlier landing was just legal for legal purposes, legal residency. It has nothing to do with tax residency. That's one of the factors for sure. But did you establish ties with Canada or not? If not, then you're not tax resident. Because often I've seen people coming in here, land here, go back, and they come back after 2 years or 3 years, and they're still filing their tax return. They don't need to. Because if you file your tax return, for sure you're going to get social benefits, but then you're subject to tax on your worldwide income. And if you're working in the Middle East where there's no tax, right, you're not paying any taxes there. So entire income is taxable in Canada, and there's no tax credit that you're going to get. Right?
So I just wanted to add one more thing. This happened to a really close friend of mine. He came over here, he opened the bank account, he got his money in, and then the advisor told him that he's entitled to those
social benefits.
Yeah, tax benefits. So he put an amount from his money into a tax savings account, and after 3 years, when he came back, and then he actually, filed this tax return. They gave him a penalty of all the 3 years that he posted, he filed for the tax return, and then you have to pay all of them back with interest.
Yeah.
So you have to be very careful what you do.
We'll get to tax-free saving accounts as well. That's retirement planning. But at this point, there are serious consequences. And in the past, CRL was not so diligent, but they are getting more and more diligent and more aggressive in these areas. So be careful, consult a tax advisor. That's the end point, right? And I think we should, in the strict interest of time, we should move forward. And if you have any unanswered question, we can address those later if that's okay with everyone.
Yeah, I think that's the way. Yeah.
Let's move on. The other areas are this. You could be resident in 2 countries as well, because Canadian residency, as we mentioned, decided based on your social ties. So if you own a house here and you have a family here, but you're personally living somewhere abroad, you could be resident in that country as well as in Canada. Right? That's where the treaties comes in, and they decide which country you are resident in, and what the treaty decided, which country has the first right to tax you. So if you are working abroad, and that country has your resident there because you're earning employment income from there, or you have your only spouse here, you're taxable in that country first. Generally, treaty will dictate that you're taxable in that country. You pay tax there. You're still taxable in Canada, so you file your tax return, report that worldwide income, and create a foreign tax credit because you already paid tax on that country. Canadian system generally allows you to claim tax credit. There are certain limitations, but generally the tax rate there is lower than Canadian tax rate, then you will end up paying more tax. If the tax rate in the other jurisdiction is higher, you will not get full tax credit in general. But the idea is you are not going to pay tax twice, and if that legislation doesn't help you, Canadian legislation, foreign tax credit mechanism doesn't help you, then treaties come into play as well, and they may avoid you paying double tax. Provincial residency generally decided based on which province you live in. Generally, December 31 is the deemed to be the provincial residence determination factor, but doesn't necessarily mean that I live here in Ontario, lower tax jurisdiction. I live here in Ontario for the full year, higher tax jurisdiction, and then toward the end of the year, I just go to spend a week in Alberta and then come back again here in Toronto. Still, you are taxable in Ontario. Right? Next slide. So we're not done with residency, but we're moving forward. Who's required to file income tax return? So income tax return is required. Again, there's a misconception. Everyone has to file tax return. That's not necessarily true. If you have tax payable in Canada for a particular year, you're required to file tax return. That is the situation when you're required to file tax return. And how you know whether you have tax payable or not, of course, you have to prepare your tax return, calculate your taxable income, and then calculate your tax payable. You have done all that work while at the file. If you have received a notice from CRA that you are required to file for whatever reason, you have to file. And if you want to obtain, there are certain social benefits, for example, child tax benefit, Ontario Trillium, provincial benefits, and there are other benefits as well. If you want to qualify for those things, you have to file your tax return, and not just you, your spouse as well, or your partner as well. So those social benefits are dependent upon your family. If you file your own tax return, your spouse doesn't file, CRA is not going to give you those benefits. And if you have a capital gain, then you have to file your tax return. So next, why you want to file tax return even if you're not required to file tax return? It means you don't owe any taxes. Why you still want to file tax return? Already talked about this. These are the social benefits. Some of them are listed here. If you want to claim credit for those things, for example, donation in this particular year, you don't have enough income, you don't have enough tax payable, you have no tax payable, but you do have donations. let's say significant amount of donation, right? You still want to file tax return. Why? Because those donations are going to go into a tax return, will be in CRS record, and you can carry those donations forward for 5 years. So next year when you have income, the donation from last year is available for you to take credit for. Similarly, tuition fee, if you have yourself or your spouse or your children, dependent children, going through getting this tuition fee, you may want to file tax return, and then, adult children, if they are transferring the tuition fee to you, then you may want to take into your tax return, even though you don't owe any taxes, but that will be in your CRS records. Yeah, please.
If you have kids and they are above 18, try to ask them to file a tax return because they might be having tuition credits there. If they are not going to file those tax returns, they will lose those benefits. That's why encourage your kids to file tax return, even they are not liable for the taxes, but they are going to get this credit for tuition.
Yeah, thank you. That's a very good point. I think the way you want to teach your kids is file tax return, you're going to get that cash. If you tell them file your tax return, they're not going to listen. So tell them there's cash sitting out there for you. So if you want to file tax return, you'll get a refund. The other thing relating to that is in some situations, some of you have children, maybe 16 years of age, they are working part-time somewhere, or even older children, and they earn some income, but that income is within that 11,000, 12,000 threshold, otherwise they don't have to pay taxes, so they may not want to file tax return. But I would suggest they still file their tax return. First is they're going to get the social benefit. Second thing is we will get into that in the next slides. RRSP. RRSP is something that you calculate based on your earned income, and this is your earned income. If your child is working somewhere part-time, making some money, 10,000 per year, they will accumulate. What's the percentage of RRSP? 12%? 80%. So if earning $10,000, still they don't have to pay tax, right? They can still contribute $1,800 towards their RSP. This room they can carry forward because they don't have money to contribute to now. But then when they start making money in the future, at least they're building their room, then they can get benefit from. If they don't file their tax return, they're not going to get. Yeah, so filing deadlines is April 30th is filing deadline, except in some cases where you have self-employment, where the deadline is extended to June 15. Interest applied. If you don't pay your taxes payable by that date, the interest is calculated based on CRA's prescribed rates. The more important thing that I want to point out here, if I have received a T4 slip, I am employment income, for example, I received a T4 slip, I know my employer will have more taxes than I owe. When I prepare my tax return, I have zero refund or zero tax payable. I may decide no, I don't want to file tax. Or I don't have time to file tax return right now, I can file later. No issues. But if you owe taxes, if your tax return shows that you have a liability, your employer will have less taxes, or your withholding is less, and on the tax return you still owe some money, and you didn't file your tax return in time, that's where this penalty is. If you don't file your tax return in time, you have to pay 5% of tax that is owing, and on top of that, 1% for every month that you are delayed in filing your tax return. Right? So make sure if you owe taxes, file your tax return. Even if you don't have complete information, file your tax return. So you are safe from this penalty. Any questions on that? Quick questions, otherwise we'll address those later. Methods of filing. this challenge.
Yeah.
So methods of filing, you have traditional way of filing either paper-based tax return. I've been in tax practice for several years. I was surprised to know that I still paper file my tax returns. One reason for that is I submit all my receipts, everything all together, so I don't have to worry about it. Once CRA assesses it, they're not going to ask for. But that's not something I encourage everyone. If you have access to internet filing, please file electronically. You're going to get your refund very quickly. They've also started the tax return preparation software that you use. They print out your tax return on a contest form, so it's not a detailed tax return. If you're writing your own tax return, prints out only 2 pages and you're confused what it is. They're barcoded printed return. So once you file it, CRA scans it and data automatically gets transferred into the records. So that's the way they're doing it. Electronic filing is you just submit your tax return to approved tax return electronic tax return filers. And internet filing, internet file internet using again software supporting documents. You need to keep them, and that's how we're going into details for how many years. Previous year's tax return, you can file your previous year tax returns as well if you haven't filed. And one more thing I'm forgetting. So for internet, telephone filing. Believe it or not, there is a way you can file your tax return through telephone. I have done. It takes a while. You complete your tax return on the paper using either manually or using software. I don't know how you can do manually, but if you simple tax return you can do manually, and then they ask for which cell you're reporting this amount for, and then you type in number. It takes forever, but you can do it.
That's the new feature the CRA introduced, and that is you can even go, and it is auto fill process. You can ask, they have their T4 with them. If you're going to find that, and you can ask them, they auto fill because box is there. Every corporation has to file T4s annually. There might be those T4s were sitting at your system. Immediately they will open and they will fill in, and it will be easy for you. You can do that as well. It's a very good feature as well.
So is that something you're going to learn, or is my? So that's it, but then I'll be contributing as well, and we'll try to stick to our time. I know we ran over.
Okay, so administrative matters. Thank you very much, Nadeem. So, thank you very much. Now, if you have been assessed, say for government assessment has been made, but you feel there is something wrong, then it is your right to file notice of objection. Notice of objection is basically within the tax department. They have certain officers there, and you have to file within 90 days. And then they can say, okay, it's going to take 6 months at least. They will respond, and then they will decide thereon. And against notice of that appeal decision on objection, you can even go to the tax court, from tax court to federal and Supreme Court as well. These are possibilities where you can do it this way, and you can. But it is normally. It is very, very easy to resolve your issues within the notice of objection, because the individual people, they are very considerate. They do consider your papers, evidences supporting, and if it is levied, they're going to decide in your favor. Next. So if you file tax return and you feel you missed something or something you want to change in, you want to say for government, you just forgotten to mention donation, or your son gave, you felt that the tax is high and your son's fee is sitting there, you can get credit. They can transfer, kids can transfer their fee credit to the parents as well. You felt, oh, the tax is now $5,000. If I'm going to make this adjustment and it can be given me some relief and tax can be reduced up to $3,000. So this is your right. You can change it and you can request them for the amendment. You have to submit this amendment. They go 10 years back as well. 10 years, it's a good thing. You must be knowing and you have to take these advantages. They are little things, but you have to learn these things. Next. Computation of Canadian tax. This is a hierarchy of the return. First of all, you have to jot down all your total income. Total income means salary, then business income, and sale of house or whatever capital gain. Those includes total income. Then you have a deduction and you have a net income. Less additional deduction, then you have a taxable income. Taxable income means it's a mechanical thing. No need to worry. When you're going to file, automatically it's going to fill about that. You should not worry about this. A good thing here that automatically it comes in and you're going to get the right thing. Non-refundable tax credit into basic federal taxes. These are all calculated over there. When you're going to fill everything, the software is going to make everything for you. It's a good thing for that. Next. We're going to make, we have a short time. Okay, so tax returns composition. Composition means, which I already mentioned, is employment income. That's on a T4. T4 normally, if you work there, corporation is going to issue you a T4 at the same time on or before 28th Feb. All corporations are supposed to file those T4 with CRA. Those will be posted there on your system, and whenever you're going to file your tax return, they will match it, and if there will be any discrepancy, they're going to write you a letter. Oh, there's a discrepancy, you declare this thing, it should be like that, and they're going to adjust something. So you should be very careful while filling this T4. Business income, if you have a business, then there is another schedule in the tax return. You have to fill that gross income, then expenses, legitimate expenses, and that the net income is going to come in. After that, property income, like the rental income. So you have a property that's sitting there, you have a rent. All properties have a different form. It will be calculated. There are some allowance as well. Say for example, you have a rent, then you can claim deductions as your property tax, your insurance, your interest on mortgage, and repair and maintenance, utilities, etc. Whatever. If someone is there, you have to prorate. If there is a tenant, you are living together, then you have to bifurcate this. This is a total area of the house, and the rental portion is this much, and you are living there. They're going to proportionate your expenses, and then net income will be included in your income. Next is investment income. If you have some investment, and you can claim some interest on that as well. That's other income. Tax capital gain allowance, capital losses. This is one very, very important. This time, last year when we filed the tax return, now here people have 1, 2 houses, 3 houses. One house as exempt capital gain. The second house, when you sell that, you have some gain on that. You have to declare now. But even your personal residence, you don't have a tax, you have to declare that. Be very careful. This you have to declare this time. It's very important. There will be a tax, 1/2 on capital gain, and there is a one column you have to take in.
open a pop-up of a new schedule. You have to, this was the address, this was my sale price. In sale price, that's there, whatever the closing figure is there. But you can reduce it with the closing cost, repair and maintenance. If you're gonna sell the house, you have to now plan something. Plan in this way that, oh, your house is this, that's got, you are expecting a gain, maybe 200,000, 500,000. There will be one half, then that will be tax transfer. But you have to manage that, how you can reduce legitimate legal framework, with a legal framework, how you can reduce that. That you have to plan ahead while you are thinking that you are going to sell this property, there will be a lot of tax. You can make additions in that, repair and maintenance, closing cost, hire an agent, you are paying something to them. All costs you can include and you can reduce your capital gain. This is the one way you have to think prior to that.
Yeah, so I just wanted to add a couple of points here.
Yeah.
One is, as Wansab mentioned, for business income or property income, including rental income, essentially whatever expenses you have incurred, that's the overriding rule. Whatever expenses you have incurred, for example, business, whatever expenses you have incurred in connection for that business to earn that business income, you're entitled to take a deduction. There are certain limitations, but that's the overriding rule. For rental income, whatever expenses you have incurred to earn that rental income, that could include property taxes, right, mortgage interest, any other expenses, agent's fee, you can deduct those expenses. That's the overriding rule, and just keep that in mind. In terms of capital gain on house, previously there used to be a principal residence exemption that still exists, but there was no requirement for you to report your disposition on your tax return of your principal house, principal residence. There are some requirements that you need to qualify to have that property as your principal residence. Of course, you have to live there. So that's one thing. But now CRA changed rules. They want documentation. So even though it's exempt, they want you to file a prescribed form, report that you have disposed of this house and you are designating it as your principal residence for these many years, and that is why it's exempt from tax. It could be exempt fully. For example, if during the period you have that property, maybe it's for the entire period it was your principal residence and you want to designate as such, then it's fully exempt. But there could be a situation where partway through the ownership you move into another house, so you were there for 5 years, whereas you held that property for 10 years, so you have principal residence exemption only for 5 years of that. So that portion of your capital gain is exempt, but the part that relates to period that when it was not your principal residence, that part is still taxable, and you have to pay a tax on that. So in terms of planning, you can plan if you expect to sell a house and you expecting to earn a gain. You may want to review your other investment portfolio, for example, the stocks and other properties. If you have inherent losses in other property or other investments, you may have capital property. If you want to sell those, trigger loss, you can offset that. You can use that loss to shelter your gain that is taxable. So those type of tax planning you can do. But if you know that this is what you are planning to, if you're planning to sell at a big undertaking and you expect to have a capital gain. Okay.
Yeah, one more thing which I want to add. Say for example, you are living at the moment in a house which value is lesser. You bought a new house and the value is higher than that. And you expect that later on you're going to sell this higher value house. What you have to do, you have to shift your residence to the other house. How you can do that? You have to change the address. You have to change driveway license. You have to tell CRA that you are the legitimate person, you are living there. You opted that property. And the first one, which has a lesser value, if you're going to sell that, there will be less tax impact on you. and at the same time you can claim the rest, which is in the higher amount as well. That's the one thing that added on that.
So common inclusions in income, the same thing with just to be repeated.
It's overlapping, I think.
There's one thing which we have to mention it. RRSP, registered pension plan. This is the same thing. Common. No. Yeah.
Moving expenses. It's very important.
Where is it?
Yeah, back. Just go back. Just common deduction from income.
So most of us normally they are in search of a job. Say for argument from here in Toronto, they move BC, some BC to here.
So this is one very common expense which you can deduct from your income. That's a moving expense, minimum of 40
kilometer radius from the place where you moved. If you are within the radius of 40 kilometer, you can claim that. You can claim that.
Even beyond 40.
I'm sorry, beyond. Not within, beyond that.
So RRSP registered pension plan is the same thing. Professional dues.
If we are chartered accountant, we can claim our fee which we pay to the institute.
Interest on money borrowed to earn an income from property.
Say for argument, I'm just doing my business and I have a property. I raised my finances to run my business. So whatever I'm going to pay on that loan, that I can claim against my income.
So other employment expenses, accounting and legal fee, this is also claimable. Child care expenses, yeah.
That can be if your spouse and you both are working and you have a kid, you can put in a daycare, and that expense can also be claimed as expense in your income.
So common non-refundable tax credits, normally people confused about that. Tax reduced by the amount of non-refundable credits. These are where up to that level where these are the mechanical all things. Personal amount up to this level, there's no tax. Spousal amount is this one, and the employment amount, these are all credits which are
mechanically calculated over there. When you file the tax return, software will automatically giving you these credits. No need to remember memory, all these things.
Yeah, we don't remember.
Yeah. Ontario property tax credit.
This is one another good thing which you can have benefit while you are filing tax return. You must remember these things. When you file your tax return, there is one portion of provincial portion schedule. In provincial schedule, you have to go there and you have to write in which property you are living there, if you are on a rent or even you are paying a property tax, when you are going to mention those things, provincial government is going to give you some credits. So remember, this is free. Most of the people don't remember, and they lose these benefits. They may be $100, $200, $150, but these are the credits regularly, monthly coming in. So you must remember these things. Sale tax credit is phased out. Only spouse, one of the spouses eligible. Government of Canada, CRA, gave because you are, as an individual, you are not registered as for HST to file a tax return. Individually, who is an employee, he is not supposed to register for HST, but he pays HST. We go restaurant, we go travel, gas, everything we pay HST. That's why government decided to give you a tax credit, but to one of the spouse. Based on the total income, they gave, but quarterly it is calculated automatically, but it gives there. Next. Yeah, this is another possibility. If you're going to buy a house, you can withdraw your RRSP, and the limit is 25,000 for a lifelong learning. It's 10,000 to 20,000 in 4 years, and registered education plan does the same thing up to maximum you can go there. Tax-free saving account, we were talking about that. The yes, Farooq mentioned that, and some people are just crazy. They have to file, and they think that if they're going to file their tax return, they will maintain their residency, but they don't know the consequences of these things. And most of the people, they have a spare money. They're going to put in tax-free account. They were not supposed to file. They file zero return. They think we are maintaining our residency, but they putting money in the tax saving account. But if you are exceeding that amount and the money is zero, you are supposed to be taxed on that. So most of the people, I have so many clients who were just making some clever movements, and they got with the CRA, and now they are paying taxes. Be very careful about this amount.
As I mentioned before, legal residency is a separate thing, totally separate thing, decided on separate facts and under separate legislation. So don't get confused. Tax residency is a different thing. They could be totally different.
Yeah, next. So federal tax rates, these are pretty calculated, and no need to remember anything, but just for your information, we gave this.
Just remember it's 53% for high income earners.
Yeah. You have to split the income. To get a lower tax rate, you have to split the income. This is legitimately you can do that, but where it is possible. You cannot split your employment income with your spouse, but retirement income you can, yes, you can, of course, you can do that.
And you will be surprised to know that even if you go to CRA website, they lay down all those planning opportunities for you. It's all, need to go to their website and read appropriate material. It's all explain there how you split your income, what are the opportunities for tax planning. It's all mentioned on CRA website. It's not that they're going to hide from you. All you need to do is just educate yourself.
These are the same thing.
Yeah, I think these are retirement plan. No one is close to retirement, so we'll see.
Some tax planning ideas are, yes, we want to talk on that as well. For government, yes.
Yeah.
Just give me. Yeah. So one thing you can do at the moment, not yes, you have few days as well. You can go for this planning app. If you have a income T4 with you, you should go to your consultant or try to fill in your T1 general, and you will arrive at this certain figure. This is tax payable. Say for example, there is a tax payable of $5,000 or $10,000, then and you not contributed any RRSP, then you should go on that and just imaginary you can fill, say for argument, $5,000. You put there and your payable tax will be automatically used because this is a direct deduction from the amount. So say for argument there was a payable $5,000 and now it reduced to putting 5,000 in RRSP, it went down to 2,000. It means you saved 3,000 just putting 5,000 in the investment. Now you are getting this 3,000 free of fund from CRA, just investing 5,000. So basically your investment from your pocket is 2,000. So be very careful. This is a very good tool. You have to use this one. So that's why normally people before 1st March, you must go there, exercise this one, what is good for you, and with the money of CRA refund, you can invest and you can get benefit. These are very tricks. You have to opt these things. Yes.
I have a question on it. So is there any method of this, any marginal tax calculator somewhere within the CRA website you are living in? You can just put it in your T4 income or whatever income you have, and then it can just calculate the marginal tax based on that marginal tax rate and how much you can put into your RRSP to get the maximized tax benefit. Is there any calculator there?
On the website, I never experienced, but I have software with me. You can maybe have your friends with you, and you can go and you can calculate. Yeah, it will give you a margin tax and the credits, whatever it is. But I never tried. But softwares which we have, immediately we can do that. Yeah. Thank you.
Thank you. So RSP, I think this slide, these are some tax planning idea that you already know maybe, or maybe there are some misconceptions. So I'll try to explain RSP and TFSA, tax free savings account. Starting with the RSP, what the concept of RSP is essentially the income that you earn today, you're allowed to contribute some of it towards your return. And government is going to tax you today on that income. So that's a very high level concept, right? So you earn 100,000, you have room to contribute, as Aman mentioned before, 18% of your earned income, not every income, earned income. It's a defined term, not every income included in that. So 18% of that income, or there is a threshold, nowadays, $26. That's the maximum. So if you're earning $1 million every year, you can contribute 18% of your income to your earnings. So 26,000 you can, and this is indexed every year, it increases. So the point here is your tax, if you're able to contribute 25,000, you are taxable only on 75,000 this year, and then rest 25,000 is sitting in your RSP account. You don't have access to that money. When you access, it's going to be taxed. So let's say, for example, after 2 years, you decided you need money, you want to draw from your RSP. That's when it will be included in your income, and it will be taxed at that point. Now, the advantage of that is it's going to grow. Essentially, you're investing towards your retirement pre-tax money, not after-tax money. That is the concept, right? You're only investing your money. Instead of investing after tax money, if you're taxed on 25,000, let's say for example, government takes away 50%, your after tax money is only 12,000. That's what you're gonna invest. You earn income on that, right? But if you are able to invest 25,000, your return is gonna be twice as much. So your investment is gonna grow faster. So that's the advantage. If you don't need that money, try to invest in your RSP. However, there is a planning that you need to consider if you're under low tax bracket. You have only, let's say, for example, 30,000 or 40,000, right, of income. Probably you're not going to get maximum benefit of contributing to RSP until you reach to a high tax bracket. For example, this year you have only 40,000 income. Probably you're not going to get benefit of contribution. So you contribute, delay your contribution into next year or 2-3 years from now when you have more income, let's say for example 100,000, 150,000, 200,000, when you are taxed at higher rate. Because if you earn anything over 200,000, you're going to be taxed at what, 53% rate? If you have 220,000 and you decide to contribute 20,000, how much you save? 53% of that 20,000. Right? Whereas if you have your income only 40,000, you decide to contribute 20,000 to income, you're under 20% tax rate. You're not going to get that maximum benefit. Yeah, I agree that your investment is not going to grow because you're not contributing there. You can invest that money somewhere else, but you're not going to get a huge tax rate if you're expecting that my income is going to be higher in a year or 2 or 3. Or 4, whatever, right? So you need to run some numbers. It's not a straightforward answer, right? So that's RRSP. And then if you draw your RSP when you retire, chances are your income is going to be low, you're not working, right? So you're going to pay less tax. So for me, if I draw when I retire, I don't intend to draw 100,000 every year. So I'll be under a very low bracket. Maybe I won't be taxed at all, right? Because I know my cousin, I try to convince him all the time, contribute. But he says, why? Because it's not, I'm going to get less cash now, and it's going to tax anyway when I draw it. I said, yeah, but that's future. When you draw, probably you'll be in zero rate, right? Tax bracket. So maybe you don't have to pay tax. TFSA is a different product. Again, CRA or Ministry of Finance, they want to encourage people to invest and contribute towards their retirement. First of all, to grow the economy, because money that you set aside gets invested, contributing GDP, right? So, but they want people to have more money when they retire, so government has to chip in less money to support, right? Whether it's ODI, or what is it, or old age benefit, right, or other social benefits, you will be less dependent on government if you save more now for retirement. Even though government is not getting their fair share, their share of taxes right now. The difference in TFSA is when money goes into your plan, it goes from your after-tax money. But when you draw that money, you don't get taxed. RSP, it goes into your plan from before pre-tax money. It grows there. When you take it out, you get taxed. So TFSA is different. You put money in after-tax money, but you can get it out, no tax. Even the income that you earn in those, you get no tax on that. That's a pretty good, sometimes it's beneficial to contribute into TFSA than RSP.
That's right.
And TFSA, you can keep accumulating your room, like RSP. If you're not contributing this year, you have room that carries forward. So I have seen friends who have not contributed in 5, 4, or 6 years. Their room is 100,000 now. They can contribute 100,000, and they will be paying less tax. So that is the overall. I think I want to explain the RSP and TFSA. Sorry? You already paid the tax. The only difference is the income that you're going to earn in that is not going to tax. That's the benefit. And in RSP, there is one downside as well. We didn't talk about that, but there are different sources of income. Some get preferred tax rates. For example, capital gain. Also mentioned, if you have principal resident, you don't have to pay tax on that. But even if it's a real capital gain, not from principal residence, it's only get taxed at 50%. So there is professional treatment, right? You pay less tax on gains. Similarly, there are dividend income that gets taxed at a lower rate. So the disadvantage in putting your money in RSP is when you draw your money, it doesn't distinguish what is capital, how much capital gain you have earned in that investment, how much dividend you have earned. All it does, what you take out, that's all your income. That's all. So if you have any investment that you think is going to generate more capital gain, don't put those investments in your RSP. Keep them outside of RSP. For example, TFSA, or not even TFSA, other investment. If you have more money, other than TFSA, other than RSP, and you expect to earn huge capital gain, put them in other investments, which is going to be taxable, but taxable at 50% rate. But again, 50% tax today, whereas RSP, when you withdraw 20 years from now, do the math, probably present value calculation, and then you will say, okay, you know what, I'm not going to get benefits, so I'm putting in RSP anyway. So I think that's all we wanted to cover. Income is playing. You can. There are certain rules in Canadian income tax where they call attribution rules. So if I have my income and my wife, she doesn't have her income, she's not earning any income, and I try to split my income with her in a way that I give her money, she goes and invests in property, any property or any investments, and earns income in that investment. Because I'm the one who funded that money, it's going to attribute back to me. So even though she's earning, the property is in her name, but because I funded it, attribution rules will apply, and I'll have to include that income in my tax return, whether it's a capital gain or I think any other income. Right? And these rules apply to passive income only, of course, because if she's working somewhere, that's her effort, not passive income. So the planning here available here is that you can loan your spouse money at prescribed interest rates. You are allowed to do that. And nowadays, the prescribed interest rate is only 1%. It's going to increase to 2% after March and after February. So if you want to do something around that line, you have investment income. If you want to invest, you want to split with your wife, loan that money to your wife. Wife is going to invest, and then the income is going to be taxed at a higher level. It's not going to attribute to you because you can legally have an agreement with her. And you're charging 1% prescribed rate. So that's a planning opportunity. Employment income, sometimes you get bonus, you can defer to get bonus into next year, but that defers tax only for one year. So, concept of integration, I think this is a really complex, topic. Very high level mention that the Canadian tax allows you to plan in a way that you are not on a level playing field if you decide to do business on your own versus if you're incorporated. So, for example, I'm self-employed. I have my own business. I'm earning income. I'm going to be taxed only, and I'm working as well. For example, I have a job as well, so I'm going to be getting my T4 slip, my business income combined together. I'm going to tax whatever rate is for the highest rate. My rate is 53% or something. So I'm going to tax on that rate, right? Versus if I incorporate, I put my money in, and the corporation is running the business. It earns income. It pays me dividend, right? So corporation gets taxed at the corporation level. So I get dividend after tax income. That dividend is taxable in my hand. Ordinarily, without these integration rules or preferential tax treatments, that dividend generally will be included in my income. I'll get taxed, right? But the government has integration rule whereby you include dividend income in your income, but the government allows you a dividend tax credit to acknowledge that the corporation did pay some taxes because the money that you're getting is after tax. They're kind of designed to, not to be disadvantageous in deciding whether you go on your own or incorporate, but they don't perfectly work. So you need to work around and run some numbers to see where you're going to be beneficial. Or, of course, one of the decisions you want to make, whether you incorporate or run business on your own, is the business concern, liability issues, all that areas. But in terms of taxation, you need to run numbers to see whether you'll be better off incorporating or you'll be better off running business on your own or partnership. So that's pretty much it.
Yeah, this is one aspect which just explain that one. But there is another aspect for this integration. That's very, very important aspect. And this Canada is among G7, G20. In corporate taxation is the lowest one. That's the beauty of this program, which I'm going to explain to you. Individually, the rates starts from 15% to 33%. But in the corporation, if you incorporated, that way back it started from 55%, slowly for the small business, CCPC. But the small business, it reduced in 2018, went up to 9%. So 33% comparison to 9% is a way difference over there. If you will incorporate your business, and you will avail those facilities with the 8%, you will be more beneficial. And why Canada is doing this thing? They have, next slide please. They give you a strategy for tax planning, 3 key tax planning strategies. So very important if you're going to do in that way. Sprinkling income using private corporation. So just incorporate the business and do your businesses in the private corporation. Maximum hold passive investment in the corporation. If you are holding passive investments, there will be a capital gain and that will be taxed at a bare minimum 9%. So another advantage. Converting private corporation regular income into capital gain, that's the same concept. You have to invest in properties. At this moment, those people who got a lot of money, they earned from the passive incomes. Houses, they sold overnight, they earned $200,000. And that was a house, one house, totally exempt, and they put in the pocket $200,000. As an employee, you are just going with that hard things. You have to spend more time, but try to do, I will suggest to you, try to do a business here if you want to earn something and put most of the passive investments in the corporation, and you will definitely being benefited with this integration. They give a comparison all over the world. Canada is the best country for the small business with the bare minimum tax. Bare minimum tax. So be careful about that. If you have an opportunity, must corporate and talk to your consultant. You will be able to get these benefits beautifully. You will be settled and you will earn more money. Next. Yeah, that was the end of our slide. These are the just resources. Thank you very much for coming and giving us some time to explain something which we were able to do.
Yeah. Thank you, Amsab. Thank you, everyone. Thank you, everyone, for coming.
Whoever will be answering the question will have to take the smaller mic, so you can hold this one in hand as well. Okay. So there are a few questions online. So can we start with the questions which were coming online? So the first one is
it?
Can losses from a closed corporation be claimed as credit in personal return?
So the corporations are totally different entities. They have their own taxable income calculation, and the only thing that comes out of corporation is either a dividend or returns of capital. Losses are stuck in the corporation. So that's the decision you need to make when you want to decide whether you want to run your business through a corporation or on your own. Is that if you're thinking that in the beginning, in the earlier year, you're going to make losses, and there are no other issues other than non-tax issues, then you may want to continue as a self-employment on your own or through a partnership, not through a corporation. Because if you're running your business as a self-employed person, you can use those losses to offset your other income. But if you're running that business through a corporation, those losses are stuck in the corporation, and only corporation can take benefit of those losses.
Yeah, just one clarification over there. Most of the people don't understand if they're running their business as a sole proprietor, and they thought that it's incorporated. But be very careful; those are not incorporated. But yes, if they have a losses sitting as a sole proprietor, they can offset against their other incomes. That is possible, but corporation losses, those cannot be offset against the income.
Yeah, I think it's worth mentioning. We were planning to do that in our presentation, different structure that you can use to do your businesses. One structure, of course, is self-employment, which is everyone knows. The other could be a partnership. You have two partners, and you can run your business through a partnership. The advantage of having a partnership is everything that's in the partnership, it flows up to you. So if you have income in the partnership, you get to include in your income. If you have loss from the partnership, that gets attributed to you. Of course, there are some limitations that's entirely a separate session. We need to do that for partnerships. But essentially, if you put money down in the partnership, you can take losses to that extent, pretty much. If you're a corporation, that's not a flow-through structure. So that's locked. If your corporation has loss or income, it has to pay. If it has income, it has to pay tax on that. If it has loss, it's going to stay there. It can use in the future because you can carry forward business losses for 20 years under 20-year rule.
Yeah, one more thing I'm going to add it. Probably the end of this question may be a little bit different. I'm just explaining something to that person. That corporation, if that is dead and have a lot of losses, but he has a one shareholder, and that person want to incorporate another corporation. That corporation has a similar business, same thing. That corporation, the loss can be carried to that other corporation. This is another possibility where this loss can be utilized in the other corporation, but that business should be same, and those losses can be rolled over to the other corporation. This is one possibility there. Thanks.
Yeah, there are anti-avoidance rules with that, and again, as I said, there are separate sets of rules for acquisition of control and streaming of losses. Wherever there is an acquisition of control, you change ownership. There are rules that you need to take care of. We can go over those, but those take forever.
Can you convert sole proprietorship to income?
And just repeat the question as well, so that people.
So the question here is, I would appreciate if you can park your questions, and for the audience, we want to address first the online questions. But I'll answer this question. So you're saying your question is, can you transfer sole proprietorship to incorporation? That's a good question, and that's the beauty of Canadian tax rules is they allow you to move from one form of business to another form of business on a tax basis. So in this case, if you have your own business and that business has grown significantly, you want to transfer that into corporation for whatever reason, maybe liability reasons, Canadian tax rules allow you to transfer that on a tax-deferred basis to a corporation, unless you take, to the extent you take only some shares of the corporation and you don't take back cash or other non-share consideration beyond your cost that you incurred to establish that business. For example, you invested $100,000 in that business, right? And now the value is $1 million. When you transfer that into your corporation, you're not going to take anything over $100,000. If you take any property over $100,000 other than shares, you're going to be taxable on that portion. So there are tax-deferred rules that are allowed. You can move business from one form of from partnership to a corporation. The Canadian rules don't allow to transfer on a tax-deferred basis on a trust. That's the only exception. Otherwise, you can transfer from one mode to another.
Yes, I'm going to add with your question. There's one rule that's called rollover. If you have a sole proprietorship and you are doing a business and you have assets of, say, for argument, $200,000, they're all depreciated assets, total value of $200,000. You have to incorporate one corporation. You should be shareholder, and all those closing balances, whatever it is, it will be rolled over in the corporation account, and same depreciation you're going to take, same thing you have to, and you have to be shareholder of that. This is the beauty of this concept as well. You can do that, but you cannot offset personal loss against the corporation, even you are sole proprietor, because your net capital will be your share capital. And if you're going to put $100 as a share capital and rest of the money, whatever is sitting there, that will go as a loan from you to the corporation. Okay. Thank you.
But again, this is a very complex topic. We can do another session on this if you're interested, and we will seek your views about that through an email.
Okay. Just give me a second. The last question online was, if you have reached your RRSP contribution limit for the year, can you contribute towards your spouse RRSP?
Yeah. So. So the room that you have is your own room for RRSP. And how do you create room? If you have earned income in prior year or current year, right? So let's say, for example, I have income of 100,000 in current year, and 18% of that is allowed to be contributed in RRSP room. So I can contribute 18,000 to my RRSP. That is not going to be taxed because I'm contributing RRSP, right? Now, question is whether I can contribute to my spousal account. I have maxed on my RRSP room. So if you have 18,000 room, you contribute to your RRSP room, your RRSP, your room is gone. You can't contribute anything more than that. But if you decide to instead contribute that particular or any portion of that room to your spousal RRSP, you can do that. How? You can assign that 18,000, 100% of the amount as spousal contribution. What it's going to do is going to give you a deduction on your tax return, but it will go into your spousal RRSP. If you end up drawing money from spousal RRSP, generally rule is 3 years. If there is no activity in that spousal account, then it will go to your spouse in the form of income. But if you draw before 2 or 3 years, it's going to attribute back to your income, as if you have drawn that money. So my suggestion would be, if you trust your spouse, transfer into your RRSP if you expect your spouse is going to have less income. If your spouse is going to have same amount of income, doesn't really matter, right? When your spouse draws money, she's going to be a higher bracket, you're going to be a higher bracket, doesn't really matter. It only matters when you expect your spouse to have a lower rate than yourself. And you don't want to draw within 3 years or 4 years time. And this concept is not just drawing money. Even if you're contributing, in year 1, I contributed in my spousal RRSP. In year 2, I didn't draw. In year 3, I didn't draw. In year 3, I did contribute more. Now that 3 period it starts again all over again. So be careful that I have heard from people saying, I contributed in year 1, and they keep contributing every year, and then they're saying, I'm going to draw from the first year contribution after 3 years. That's not the case.
So just a question or maybe clarification. So if you contribute to RRSP, then your pension contribution is also impacted, right? It's reduced, right? So
yeah. So there's a pension adjustment, and that reduces your RRSP room. What happens if your employer contributing some amount into your RRSP as well? Then that amount doesn't get taxed, but it reduces your pension, your RRSP contribution room. That's all.
But that's all when we get the tax return assessment. But when we get the assessment and everything, the room that is written over here, over there, is after all the adjustment.
Yeah.
After all the adjustment that is because of the pension or anything.
Yeah.
The number that you see is clearly available.
If you have currently entered pension contribution amount, so that amount generally reported on your T4 slip. If you have correctly entered, it's going to calculate your next year hours.
One question, like once you said that the advisement to invest passive income in corporation. Yes. So is it advisement in case of passive income? Because in corporation, passive income is taxed at higher rate. The quality, it would be like that. The revenue shares in corporation is available only on
Yes, so
I'd like to clarify.
Yes.
Yeah. Passive income, investment income will not be taxed on this profit. It will be taxed on the 50% rate with the refundable.
That's right.
taxes.
Yeah, that's right.
So that was not accurate. The statement made. Passive income in a corporation will not be taxed at the small business rate. I agree with you.
Yeah, the only advantage is that you can keep reinvesting that money, but be careful. There is next week is budget, and our finance minister is going after that income is sprinkling all. So be aware of that, and there will be new rules that will come in. They're going to attack these. The entire private business taxation probably regime is going to change. These are the biggest private and company taxation changes that have been announced for a while. They have not been enacted, and some of these are withdrawn. So hopefully they're going to come up with clarification or new rules in this budget. So keep an eye on that.
Yeah,
So I would suggest don't undergo any planning at this point until you're clear what's going to come out in that.
how can we put passive and active?
There are complex rules in the Act. In general, passive is high level. I'm not going to go in legal definitions. So that's very high level concept. For example, salary income. You're really making an effort. You're working, and then you're getting, right? Business income. You're fully involved, and you're running a business, right? I have money. I invest in. I incorporate. Put that money in my corporation. That corporation buys a property that is being managed by someone else. I'm not actively engaged to run that business, right? But I have 5 properties, right? And there are some specific rules that generally rental income is passive, but there is a specific rule in the Act where if you have rental as your business, means you're employing, and there is specific mention if you're employing more than 5 full-time employees, then you qualify for that exception, and that business will be recharacterized as active.
Even if I am doing investments, still there are rules for that because I think investment income and specialized companies are not.
That is correct. Again, goes back to the same thing that if you're really doing that as a business, right? All I do, I have a corporation, or I'm engaged in a corporate. I'm the owner of that corporation. All that corporation is doing, managing a big portfolio of investment. That's going to be active. But the downfall is you're not going to get preferential treatments for dividend or capital gains because that's your business, right? That's not your capital gain or passive activity. So one downside is going to be taxed at total flat rate, general rate rather than capital gains rate or dividend rate, but the advantage is going to be active business.
Yeah, question. Is there a borderline difference where the capital gain activities can be treated as normal business activities and the normal business rate or vice versa?
Again, similar to residency rule, this is a very contentious topic. What is capital? What is income? So, and there have been hundreds and thousands of court cases. And this is always because the main reason is because capital gains get preferential treatment, right? So CRA wants to argue that this is not capital gain, and taxpayer wants to argue that this is capital gain. If you have loss, CRA want to argue that this is a capital loss, and the taxpayer is going to argue, no, this is not a capital loss, this is income loss, right? Because there are limitations on using that capital loss, so you want to trigger loss that is not a capital loss. So it's a very contentious topic, but again, as I mentioned, if you incorporate and you're investing in hundreds of properties, that's all this corporation is doing, and they qualify for that exclusion, which is, sorry, if all you're doing is trading in stocks, let's say for example, even if you earn capital gain, that's going to be considered as adventure in the nature of trade, and that will be characterized as your ordinary income, not as capital gain. There could be a situation if you don't do day trading, but you do engage in investments, you can do an election whereby you can say this is my capital investment. You need to qualify for the election. So it will make a determination that, yeah, you qualify for that election, and then this property is your capital property. Any income that you earn or capital gain you earn is going to be treated as capital gain, not as income. But again, you have to prove with all facts going forward as well that you're not doing a day trading. You're not doing any adventure in the nature of trade. So you have to keep substantiating that.
But this applies the same for rental properties as well. Investment would be day trading. When you have rental properties,
you're buying and selling, that's all you're doing?
No, so if you bought 2-3 properties and you have like for 5 years.
Yeah, then probably chances are it's going to be capital gain.
Let me explain the basic difference because there's some confusion. First of all, whatever you're going to do a business, you have one business should be your core business, where you put your efforts, you do some exercises to earn some money. Say for example, if you have a property, 6 properties in your corporation or in your personal name, and this is the only business with you. You have to run around, you have to take the care of tenants, then everything you have to repair, maintenance. This is your core business. Whatever gain will be from that property, this is your core business. This is not ordinary business. This is your running business. There will be income. All rental income will be a normal income. You have to claim those things. And so where you are dealing in those properties, this is your main business, then you cannot claim those capital gains.
Selling the property, any one property, any case would be a normal business.
But in corporation, there's one rule, special rule. Those assets on which you are claiming depreciation, those will be treated as a normal gains in the business. Normal gain, not capital gains. That's the rule.
I think the determination is whether your property is capital property or not.
I think we should stay away from this.
Okay.
Yeah. 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 And believe me, we deal with these situations in both big corporate scenarios where we involve legal counsels, even though the rule says, but it's not black and white. So you need to determine, okay, what was my intention when I purchased the property, what my other activities are. So it's not a very straightforward answer, but generally if you have one property, keeping it for a long time, chances are it's going to be capital gain when you sell it. But of course, when you sell it, and if you're claiming depreciation on that, you need to factor that in and record as a recapture of previously claimed depreciation. And then any access is going to be a capital gain.
Due to time constraint, can you just take the last 2 questions and we can answer, and the dean is also here, so you can ask questions.
So if you have a corporation and you know that you have an income which is not very active, what would you recommend? Should you be, does it make a difference to that corporation or to your personal practice?
That's as you mentioned below, before, it's usually beneficial to have that in your own rather than incorporating. But if you intend to keep money in the corporation for a long time, you don't want to draw, then maybe keep it there. It's going to be taxed at higher rate, but at least there is no second level of taxation.
There was some change in the transfer income.
What's that, sorry?
Transfer income for personal taxation.
Again, we're not going to get into that topic because that's again a contentious issue. one income splitting planning idea that is still valid is loaning money to your spouse. That's all. There is the other planning ideas are subject to changes that are forthcoming, so I don't think there's a point of getting into that discussion.
Because all the transactions, whatever they have, the substance of transaction depend upon the substance of the transaction. You have to determine either that is capital gain or business income. There are a lot of issues. So apparently we can't say do this and you are going to get this thing. Situation differs with each case.
So I was just asking about specific change. Specific change. Thereby, we are not allowed to transfer the income.
That's retirement pension income splitting is still available. I don't know how does it work. I'm not in that age bracket yet. But there is opportunity for pension income to be. Yeah, it's still valid. It's still valid. There was one opportunity, one relief that was given by the previous government that you can, I don't know what it's called, family something $2,000 credit that you could get, but that's been taken away.
Thank you everyone for joining, and thank you Nadeem and Awansa for such an insightful. Because it was we did some changes this year in this session. We tried to do it online. We had some 9 or 10 participants from Calgary, Edmonton, Ottawa, and some of the other places. And I think it was fine, but there was some. I forgot about non-GTA members while I was talking about them. So we did this online for the first time, and it took some effort from the management committee, but we'll get the feedback how did it go. Hopefully going forward we'll do all these events which will be available online. Hopefully the recording was good as well, other than my picture in some areas which we can delete later on. Few things to mention. Very glad to see all the members. Thank you for coming. It shows that people appreciate all the effort this management committee put in. Second thing is thank you to Awansa and management committee and Nadeem to put this all together. Also, we are our ICAP president Riaz Awansa is visiting Toronto late March, so we are planning to have an event where we meet the president. The details will be shared shortly. Hopefully, he's coming on Wednesday, Thursday, Friday. So hopefully, it will be a detailed. We are finalizing the event details, but we'll share it with you as well. If you can join, that would be great. It's always good to ask some questions directly with the ICAP president, and it's a good networking. It provides also some good networking opportunity. Okay, thank you everyone. Thanks. So the last few things is once you'll be leaving, we have shared the CPD spreadsheet. If everybody has signed it, that's okay. If you have not signed it, just make sure that when you are leaving, you sign it. Last thing, you put your membership number as well. This is what Experience is talking about. They need membership number, otherwise it gets difficult to get the CPD credit. Also, when you leave, just drop this badge so that we can use it, recycle it for the next time as well. Thank you, everyone. Thanks.
So another point I wanted to mention is that the increase in number of membership here, we are going to be more active now in terms of arranging our CPD session. This was first of those sessions. We have formed a CPD committee. Uruj is a member of that. I am a member of that committee, and we had asked members to send their CTV committee, and we have received how many 3 or 4? Yeah, so we have received 3 or 4 names, and we can assume from that CTV committee formally and plan our future activities. And Rob mentioned there's one activity that well, that's not a CTV. Yeah, but there's another event coming up. I just wanted to, we're going to send you an email out. It's just been organized at the PwC's office in downtown on March 22nd, which is on AI and robotics. And actually, the exact title is Future of Work, I think. What's going to happen to all these artificial intelligence coming up? What's going to happen to the routine or traditional employment streams? So we're going to talk about that, and we'll send that invite out to you because we are part of that as well. Alone, we can do too many CTV courses too much, and they're not beneficial for so many members. So we're trying to collaborate with our organization as well. And this is one of those events. As I said, we will send out an invite to you guys, and then you can sign up.
Okay, thank you, everyone. We'll be just arranging snacks and we can start the networking right now. Thank you. Thanks, everyone.
Thank you.